The U.S. Fed left rates unchanged as expected, saying the risk of higher unemployment as well as higher inflation have risen. For more on the outlook for the American economy and the Fed's rate roadmap, let's go to Randal Quarles, former vice chair of the U.S. Fed. Thanks for joining us today.
Thanks for having me.
What does this decision by the Fed tell you?
Well, as you said, it's expected, and I think it's the right stance for the situation that we're in. The Fed has two main tasks, to keep employment high and inflation low. Inflation is higher than the Fed's target, but it has come down, and it's not appreciably worsening. Unemployment is relatively low, and the employment situation is pretty stable in the United States at the moment and is not contributing significantly to inflation. Wage pressures aren't contributing significantly to inflation. So that suggests that a steady as she goes stance is probably right, particularly given the amount of uncertainty about the future path of the economy in light of uncertainty about the future path of American policy. So I think it's, I think it's not only to be expected, it's almost inevitable that that would have been the Fed decision today.
You mentioned both the mandates for the Fed. Which one weighs more heavily on deciding the rate, or are they sort of equal?
They really are sort of equal, I think. And obviously they feed into each other. If you have a labor situation where there is significant upward wage pressure that's driving into inflation, that argues for a particular stance of monetary policy. If the economy is slowing, and that will typically result in unemployment rising and a very weak labor market, and that will both of those together argue for another stance of monetary policy. Where the Fed has a challenge currently, and where the members of the committee that set monetary policy for the United States are not in complete alignment, unlike the situation for the last few years where there's been almost universal agreement on what the path of policy ought to be, is that you could see a situation developing where the labor market could weaken at the same time as inflation is increasing. And if that were to happen, the Fed would not prioritize one objective over another as an intrinsic matter, but would simply say, well, which appears to be the worst problem in the current environment, and which appears to be most responsive to the tools that we have to address it. I expect that would probably be labor policy rather than inflation, if inflation is being driven by tariffs, because there's not much that the Federal Reserve can do to respond to price increases that are being created by an administrative action such as tariffs, whereas they might be able to use their tools to sort of generally affect the environment for the labor market. But it really would be not saying that one of these is more important than another per se, but which appears to be the most immediate problem and the most susceptible to our addressing it.
Jerome Powell did speak to why he won't take preemptive action. He was asked, why not take a step now to avoid, for example, a hit later on either to inflation or to employment. Can you explain a little bit why he would not be likely to do that?
Well, several years ago in 2020, the Fed went through a comprehensive review of monetary policy. It was really the first time that the Fed had ever done that. In Canada, for example, that's regularly done by the Bank of Canada, and it was looking at examples like that caused the Fed to say this is a good practice. And in that comprehensive review of how the Fed ought to conduct monetary policy, one of the things that the Fed concluded was that, again, in the current environment, in the modern world, the tools that the Fed has act quickly enough that you can wait until you actually see signs of one or another of these measures that the Fed wants to focus on, is mandated to focus on, moving before you act. If you act preemptively, you run the risk of less optimal policy outcomes. The principal example at the time was in the past, the Fed would, as you began to see the unemployment rate fall, the labor market strengthen, the Fed would preemptively act to constrain the economy to prevent, employment from getting even stronger, believing that that would feed inflation. Janet Yellen, as chair of the Fed, said, no, we can afford to be more patient. And as a result, you had millions of more people put into work without significantly increasing inflation in the United States. And so the Fed has concluded that all things considered, it's better to, as I have called it, wait until you see the whites of their eyes with respect to some of these measures before firing in order to achieve better outcomes. We actually saw that happen.
Given that they're in a wait-and-see position, how long do you think the Fed can or will watch the tariff situation unfold before they are forced to make a decision?
Well, I think it depends on, obviously, it depends on how the data develops, and the Fed always says that. But I think the key thing is, do you see inflation expectations become unanchored? Prices, obviously, in an environment where new tariffs are being applied, prices will rise. But other things being equal, that should be a one-time step up as a result of applying the new tariffs or taxes, as opposed to an inflationary spiral. Where you'd get an inflationary spiral is if people, is if that one-time increase persuaded people that they needed to ask for higher wages in order to afford the more expensive goods, or companies needed to increase prices even further. So if you saw those expectations become unanchored, and there are some indications that people are expecting higher inflation other than just one-time price changes. So if that flowed through into continuing data, then the Fed would have to act. Right now, you haven't really seen that. And so, again, I think the Fed's wait-and-see stance is appropriate and will be maintained until you start to see it.
Randal Quarles, good to have you on The Closer. Thanks very much for your time today.
Thanks for having me.